Have you ever wondered how the current state of inflation is impacting our economy? Let's dive into some recent data from the Federal Reserve's preferred inflation gauge, the Personal Consumption Expenditures, or PCE Price Index. In January, the headline PCE Price Index rose by 0.6% compared to December. This indicates that inflation continues to be a reality we grapple with. Now, if we exclude food and energy, we see the core PCE Price Index increased by 0.4%, which is slightly lower than December's 0.5% rise. But how does this compare to last year? Well, overall inflation remains stubbornly above the Federal Reserve's target of 2%. In fact, January's PCE inflation stands at an uncomfortable 4.7%. That's down from the peak of 7.1% we saw in June of 2023, but it's still a cause for concern. So, despite some improvement, inflation remains a significant concern for the Federal Reserve. Now, what could these inflation figures imply for interest rates and the economy? The implications of the recent inflation data are multifaceted. Primarily, this data could influence the Federal Reserve's decision-making regarding future interest rate hikes. Despite some improvement, inflation remains a pressing concern. Although the Fed signaled its intent to raise rates in March, the latest numbers might cause them to reconsider the pace or magnitude of the increase. On the market front, the stock market initially dipped slightly following the news. This reaction encapsulates the uncertainty surrounding the Fed's next move, as traders and investors speculate on the potential impact of inflation on the global economy. The impact of these inflation rates extends beyond Wall Street and into the wallets of everyday consumers. Elevated inflation continues to erode consumer spending power, potentially slowing down economic growth. Similarly, businesses grapple with rising input costs due to inflation, which impacts their profitability. This could lead to further price increases for consumers, fueling the inflation cycle. Therefore, consumers and businesses should brace themselves for a continued environment of higher prices and potentially slower economic growth. What does the future hold concerning inflation and its impact on the economy? That's the question on everyone's mind. In the days ahead, the Federal Reserve will keep a sharp eye on inflation data and other key economic indicators. This will help them assess whether further adjustments to monetary policy are necessary. But keep in mind, the Fed doesn't consider just one measure of inflation. They analyze several, including the Consumer Price Index, or CPI, to get a comprehensive picture of inflation trends. It's like assembling a jigsaw puzzle, each piece providing a little more clarity on the overall image and helping inform their decisions. The road ahead may be uncertain, but one thing's for sure. The Fed's ultimate goal is to navigate us towards price stability. This is generally defined as inflation hovering around 2%. Why this figure, you ask? Well, it's seen as the sweet spot that helps maintain a healthy and sustainable economic environment. It's a delicate balancing act, but one that's crucial for our economy's well-being. Achieving price stability, generally defined as inflation around 2%, is the Fed's goal to maintain a healthy and sustainable economic environment.